Topic: Global regulation examines the purpose, structure, and evolution of financial market regulation across major global jurisdictions. The topic explains that regulation is essential for maintaining financial stability, protecting investors, promoting market integrity, and reducing systemic risk within increasingly interconnected global markets. Alternative investments such as hedge funds, private equity, real assets, and digital assets often involve higher complexity, leverage, and liquidity risk than traditional investments, making regulatory oversight especially important. Regulatory systems seek to balance market innovation with investor protection and economic stability. The topic focuses on the regulatory frameworks governing alternative investments in the United States, Europe, and Asia, highlighting both regional differences and the growing trend toward international regulatory coordination and supervision. Financial market regulation serves several critical objectives within the global investment system. Regulators aim to promote transparency, fairness, accountability, and confidence in capital markets, while reducing fraud, misconduct, and excessive risk-taking. The topic discusses different theories of regulation, including public interest theories that focus on protecting society and private interest theories that emphasize political and industry influence. Regulatory authorities oversee market participants through registration requirements, disclosure rules, reporting obligations, compliance examinations, and enforcement actions. Because alternative investment strategies may involve leverage, illiquidity, derivatives, and opaque structures, regulators closely monitor these markets for systemic risks. Effective regulation also supports efficient capital allocation, investor trust, and the long-term stability of financial systems during periods of economic uncertainty and market stress. In the United States, alternative investment regulation is shaped primarily by the Securities Act of 1933, the Securities Exchange Act of 1934, the Investment Company Act of 1940, and the Investment Advisors Act of 1940. Hedge funds and private funds often rely on exemptions from full registration requirements through private placements under Rule 506. These exemptions allow funds to raise capital from accredited investors and qualified purchasers while limiting public advertising. Regulatory oversight includes compliance programs, custody requirements, performance reporting standards, trading practice supervision, and periodic SEC examinations. The topic also emphasizes the role of chief compliance officers and organizational compliance cultures in maintaining regulatory standards. U.S. regulation increasingly focuses on systemic risk oversight, transparency, and investor protection within alternative investment markets. European alternative investment regulation is largely governed through harmonized frameworks established by the European Union. The Alternative Investment Fund Managers Directive, AIFMD, represents the primary regulatory structure overseeing alternative investment fund managers within EU member states. The AIFMD establishes authorization requirements, leverage limits, liquidity oversight obligations, risk management standards, and disclosure requirements for fund managers. European regulation also involves coordination among supervisory bodies, such as the European Securities and Markets Authority, ESMA, European Banking Authority, EBA, and European Systemic Risk Board, ESRB. A key advantage of the European framework is the passporting system, which allows authorized managers to operate across multiple EU jurisdictions under a unified regulatory structure. European regulation places strong emphasis on systemic stability, investor protection, and coordinated supervisory oversight. The topic also explores alternative investment regulation in Asia, where regulatory systems vary significantly across countries and financial centers. Major Asian jurisdictions such as Singapore, Hong Kong, Japan, and China have developed increasingly sophisticated regulatory frameworks to support growing alternative investment industries while maintaining market stability. Regulatory authorities, such as the Monetary Authority of Singapore (MAS) and the Hong Kong Securities and Futures Commission (SFC), oversee licensing, disclosure, compliance, and market conduct within their respective markets. Asian regulatory approaches often balance financial innovation and economic growth with prudential supervision and investor protection. As Asian financial markets continue expanding globally, regulators increasingly cooperate with international organizations to strengthen transparency, harmonize standards, and address emerging risks associated with alternative investments and cross-border capital flows. The topic concludes that global financial regulation continues evolving in response to innovation, globalization, technological advancement, and changing market risks. Alternative investments require particularly careful oversight because of their complexity, leverage, liquidity constraints, and potential systemic implications. Although regulatory frameworks differ across the United States, Europe, and Asia, common objectives include investor protection, transparency, market integrity, and systemic risk management. Effective regulation must balance the need for innovation and market efficiency with prudent safeguards that maintain confidence in financial systems. The topic emphasizes that investment professionals operating globally must understand multiple regulatory environments and remain adaptable as rules evolve. Ultimately, strong regulatory systems contribute to healthier financial markets, improved governance, and greater long-term economic stability worldwide.